Okay, so this session we're going to go over moving averages. And pretty much what I'm going to be discussing today is going to be primarily exponential moving averages, simply because that's what I use. And why do I use those versus simple moving averages? You know, the EMA versus the SMA. Well, I personally like the EMA better because it gives greater weight to more recent activity. But basically, it reacts faster to price changes than the SMA does. So with the kind of trading that we're doing, day trading, we want those. We're more into or pay more attention to recent, what's going on recently, okay, versus what's going on, way back in a long time ago or however much time frame that you're looking at. But now some people will use EMAs for shorter term, trading, day trading, and things like that, and then, but they'll keep SMAs up on their daily chart, and they'll use SMAs for their daily. Some people switch it up like that. I just use EMAs across the board on no matter what chart I'm looking at. But some people do that. So, and that's the difference. EMAs are just more weighted on recent price changes than SMAs are. And you can toss up, get on your whatever chart you want to. It's going to show up better on your daily chart. And look at the difference, where the SMA price is and versus where the EMA price is, and you'll start to kind of get a gauge on what the differences are. So, and keep in mind that these moving averages, they're all lagging indicators. They're not future predicting indicators. So the basically what they are is like, let's say you're looking at this 1 minute. We're on a 1 minute chart right here on this semi stock. So if we're looking at the 200 EMA on the 1 minute chart, a lot of people think, well, we're on the 1 minute chart and that's a 200 EMA, so that goes back 200 days. Well, that's not the case. It goes back whatever time frame chart you're on. So if you're on a 1 minute chart, that 200 EMA is going back 200 minutes or 200 candles, right? And same thing with a 5 minute chart. It's going back 200 5-minute candles. On the daily chart, then yes, it is going back. Since a daily chart, each candle represents 1 day, then yeah, the 200 EMA would be a 200-day basically moving average, right? So same thing with your 50 and your 9 and whatever other ones that you're using. Just keep in mind that it's going to be, that's why you're going to see a different price on the 1 minute chart for the 200 EMA than you will the daily chart or the 5 minute chart. The price will be a little bit different. So keep that in mind. A lot of people think that these are all, no matter what chart you're looking at, they're 50 days or 30 days or 200 days, whatever. That's not the case. It's just the amount of candles back that you're looking at on whatever chart that you're looking at. So basically, the most popular ones, okay, so I use a 9, a 20, a 50, a 100, and a 200. The 100, it's probably a little less used. A lot of people will use 4. They'll use the 9, the 20, the 50, and the 200. I throw a 100 in there just because it's one more line, and sometimes you can certainly see that act as support or resistance levels. So I use those 5. And when you're looking at the short-term EMA, which is going to be, in my case, the 9, some people will use an 8, some people use a 9, and some people use a 10. Totally up to you what you want to use. I use the 9. So that's considered your short-term EMA, right? So your medium-term EMA is going to be the 20. And some people use a 21 instead of a 20. And same thing with the 50. That's going to be more your long-term EMA. Some people, instead of using a 50 like I do, they use a 55. And so on the 20, instead of using a 20, they use a 21. And on the 50, they use a 55. Why do they do that? Well, those are kind of fib levels, right? So that's why they choose the 21, 55. That's 100% up to you which one that you want to use. What I like about the 100 and the 200 is the 100, it represents kind of close to around 6 months worth of trading, and the 200 is around a year worth of trading. There's about 250 or 252, I think it is, trading days within the year. So, if you're on the daily chart, you're kind of looking back at almost a year full of trading. So, but I do like the 200. If I were going to knock one off, if I needed to, I would knock off the 100. And I keep the 200 a little bit thicker so it's easier for me to see. And I keep mine the same color all the time. That way I know right off the bat. I don't have to look up here. I know that my 9's blue. I know that my yellow is 20 and my red is 50. My green's 100 and my orange is 200. So pretty quick, easy way to recognize them. And again, we're using these EMAs because that's what other traders are watching as well. They're popular indicators, right? So we can possibly see more people using those indicators, using those levels for looking for certain things to happen, whether it be a bounce or a reversal or a breakthrough or a breakdown below, whatever they're looking for. We try and stick with these popular indicators. And so EMAs will show you the trend, right? From the shorter term trend, looking at the 9 EMA, to longer term trends, like looking at the 50 or the 200. They're going to show you that trend. And when you're looking at these EMAs, I'll give you an example here. Let me find one. Okay, so you can see how these EMAs are pretty contracted here, right? So they're all kind of in the same general area here, right? Well, that's typically going to show that not much is going on, right? There's not a lot of movement going on there. It's probably, even if you didn't have candles on this chart and you were just looking at the EMAs, you would probably be able to ascertain just by looking at those EMAs that we're pretty much sideways trading, right? So once we start seeing some separation from the EMAs, that's when we're starting to see some type of price action going on, whether it be to the upside or to the downside. In this case here, it is to the upside, of course. So, obviously since the 9 EMA is the shorter term EMA, this one's going to take off before the other ones, right? So once this one starts taking off and then this one starts taking off, then you're going to start to get that spread. And then if you look at this spread, look how much of a difference is between your convergence down here of all of the EMAs, right? To look at them now. This huge band. So basically we can tell by that the more of a spread in these bands that we have, the more that they're expanded, right? The more strength that is in that move, okay? And you can see this was a pretty strong move up, right? And we see that in the bands. And I'm going to go over later on how to place some trades based just on the EMAs. So basically, whenever this thing starts going up, this one, the 9 EMA is going to get pulled faster than the longer term EMAs. Just, keep that in mind. That's pretty common sense, but just wanted to point it out. So, we can also look at when they start to contract again. Now here they're starting to contract a little bit more. So likely what that's showing is that the energy in that move is slowing down. Right, so these are going to get all the way back down. They may even come all the way back down and contract all the way like they did before. So that's what using the different EMAs can show you versus just using one, right? Some people say, well, I just use the 9 EMA. Well, that's fine if you just use the 9 EMA. But if you're using more EMAs, you can get away with just 3. You can get away with just the 9, the 20, and the 50 when you're day trading. But the more that you use, the more you'll be able to see that expansion happening, and what's going on. And you can also start to look at your longer term EMA here, the 50. Once it starts to flatten out, it's no longer kind of really going up, right? It's starting to flatten out. Then that's when a lot of people look to start getting out of the trade, right? And we'll go over that some more here shortly. Okay, so you also, when you're looking at these moving averages, you don't want to just grab a trade based off of the moving average itself, right? You might get lucky on a trade here or there, but what we want to do is, if you were to back test if you took a trade every single time that the 9 EMA broke the 20 EMA, right, and you back tested that, and it came up to be 30%, let's say, success rate. Well, that's not a great success rate. We want to look at really 40% and better. And you might be asking yourself, well, Doc, if we're only getting 40% success rate, then we're losing money. Well, no, not really, because keep in mind, your losses are smaller than your gains, right? So we can typically get away with about a 40% win rate. But how can we make that win rate better than 40%? Well, that's when we start looking at other indications besides just the EMAs. I've talked about that many times. We're always trying to find as many indications that are nodding their head, yes, that looks good, before we hop in. So, we want to look at, okay, so the 9 EMA crossed above the 20. Okay, great. Do we have volume there, right? Is it in a key area? Did it just break a key resistance area, right? Did it break a swing high? Did it bust through VWAP in that same area? There's a lot of times that you'll see VWAP will be right around in those same areas where you'll see a crossover. Maybe if there was a resistance level, a major key resistance level right here, and you were looking to take this trade and everything else looked good, you had volume, you had some support down here, everything else on the trade looked good, but there's a resistance level right here. Well, maybe you wait. Maybe even though you crossed up here, maybe you wait until you break that key resistance level, right? Okay, so you also want to match them up with chart patterns. Did you just get a double bottom? Do you have a bullish engulfing candle, a hammer, wedges, whatever? How does the ladder look? Is the ladder and time and sales and level 2, do those look bullish, right? So make sure, and I preach this many times, and I always like to reiterate it anytime I can, is try and match up as many different indicators as you can, and just don't go off of one indicator, because this EMA trading is a strategy in its own, right? There's a lot of people that's what they trade. They trade, hey, every time the 50 EMA crosses the 200 EMA on, they call it the golden cross. When it crosses that on the daily chart, I'm picking up a trade on that, whether it be intraday or swing or whatever. So there's a lot of people that use that as a strategy, but I would not suggest using solely that one indication, because oftentimes it can certainly fail. So that's how we can increase that percentage. We can get it above 40% and 50% and 60%. Wherever you're trying to get to, you just start looking at back testing and saying, okay, well, every time that the 9 EMA crossed above the 20 EMA, it was a 30% success ratio. Well, every time it crossed above and did the same thing, but it had a whole bunch of volume, well, maybe it was a 38% success ratio. Well, every time it did it and it had a bullish engulfing candle, well, then now it's a 46. You got to see where I'm going. So you can back test these things yourselves and see what all you're looking for in order for that particular strategy to be have a very good winning percentage rate for yourself. Okay, so we talked about spaces showing the strength. We talked about watching for the longer EMAs to like the 50 to start to flatten out. All right, and let's see here. Let's go to some of these guys will have some rules in place when they're trading this particular strategy, right? They'll say, okay, well, if on the daily chart, if we're trading below the 200 EMA, right? Doesn't matter on the 1 minute chart, but on the daily chart, if we're trading below the 200 EMA, then they're just not going to take any longs, right? And they're not going to take any longs on this particular strategy, even. And some people may say, well, hey, if we're trading below the 20 EMA and on the 1 minute chart, then I'm not going to take any longs. I don't care that the 9 EMA busted above the 200 EMA and it busted above the 50. If we're still trading below a certain EMA, you just don't take that trade. So make sure and set those rules up for yourself based on the back testing history, so you can make sure that it's going to be consistently profitable strategy for you. Somebody asked me just the other day, we were having a little kind of one-on-one deal. They were having a tough time coming up with a strategy. This strategy can be very, very simple strategy, trading these EMAs, and we'll get a little bit more into that. So, and this had several people ask me whenever I went over, we had that session on risk management, and I was talking about rules, right? So I've had many people ask me, hey, Doc, I don't know what you mean by trading rules. Like, what do you mean by that? What kind of rules are you talking about? Well, let me give you an example based on this particular strategy, okay? So, we talked about maybe one of your rules is, and these are just examples. These are not what you live and die by. Just examples of rules that you can place for yourself, okay? Based on a strategy. So these would be strategy rules. These wouldn't necessarily be risk management rules. They would be strategy rules. So let's say that, like we talked about before, that if you're trading below the 200 EMA or the 50 EMA on the daily chart, well, you don't take any longs on that particular trade, because maybe that's you're in a downtrend, obviously. So maybe that's one of your rules, right? And when the 9 EMA crosses above the 20 EMA, maybe that's your strategy, right? But it's already above the 50. Maybe you don't take that trade, at that point. Maybe you don't take the trade unless the cross, whatever EMA cross that you're looking for, whatever that strategy is, maybe you don't take that cross unless it happens at another key area. Maybe it like we talked about a minute ago, maybe it broke through a resistance area, right? Maybe you don't take the trade also if there's not some type of bullish chart pattern present. We talked about what some of those chart patterns could be. And then maybe you don't take the trade if it just broke the current trend line, right? Because you're not sure what it's going to do, because now the trend is broken, so you're not sure which direction you're going to go. So if all of those other things match up, but one of your rules is it has to be within the current trend line. If it's not, then you don't take the trade, right? And these are all things that will help your trade winning percentage be higher the more rules you have. Now, obviously, the more rules you have, the harder it's going to be to find setups, but the more likely you should have a positive trade, right? And that's all done with back testing, of course. So, and maybe another rule is that, like we talked about it a minute ago, is there's not any key resistance levels right there in that immediate area where you're looking to take that trade, because you could hop into the trade, and then 10 cents later you hit that resistance level and it doesn't break, and it just sells off hard from there. It gets a big rejection, from there, and you end up hitting your stop loss. And we talked about looking at the ladder and making sure that those are bullish. Maybe that could be a rule for you. So anyway, I think you guys kind of get the idea of what some rules can be. And when you're developing these strategies, or even fine-tuning these strategies, you can implement some of those rules, back test it, and see if it improved, right? See if the percentage went up, and just keep playing with it until you get to where it's in an area that you're comfortable. So I just wanted to give you guys some rules examples, simply because I've had a lot of questions about it lately, a lot of private messages on it. So let's talk about some strategies here. So there's certain people, certain scalpers, certain traders that scalp, and they'll use a 3 EMA crossing the 9 EMA. So let me play with this a little bit. I'm going to take some of these off here for a moment, just so I can show you guys some different strategies. As a matter of fact, let me show you all how to set this up. Okay, it might be different on your platform, but if we were to go here and I just dump all these EMAs, right? And then I go to, since I want exponential, I'm going to go to EXP. So there's moving average, exponential, right? So I'm going to, since I like 5 of them, I'm going to double click it 5 times. 2, 3, 4, 5, right? So now I've got 5 up there, and it defaults to 9, right? So what we need to do is we need to change the numbers on those. So I'm going to go to settings. I'm going to change this 9 to a 20. I would change the color too, but it's going to take too long. I'm not going to do all that right now. I'll just get back. I'll load my other ones in a minute. Then we want to have a 50. I'm just changing the length, and you can have it on whatever you want, open, close, whatever. I have mine on close, and most people have it on close. So basically, when you're averaging those, let's say you're on this 50 EMA, and you're on this 1 minute chart, it's going to look at the last 50 candles, right? And it's going to take the close price of the last 50 candles, add all of those figures together, and divide by 50. And I like to do mine off of the close. So there's the 50, and then we'll do a 100 here. You're just changing the time period. That's all you're doing here. This is just how you set it up real easy, real quickly. And then, okay. And then, of course, you don't want them all being the same color, right? So you would go in and you would change to whatever color you want. You do that right here. You want to make that one yellow. And you make this one red, You guys get the idea. So that's how you set them up, right? So I'm going to go ahead and cancel that. Okay, so let's talk about some different strategies, and I am going to delete some of these. I'm going to delete this one, and this one. Let's change this to a 3. And some people will use this strategy where it is a scalping strategy. So the 3 EMA is going to be the yellow, and the 9 EMA is going to be the blue. So what they're looking for is they're looking to take a trade when the 3 breaks the 9. This is for most people are using this for a scalp strategy, okay? And then they're looking to sell when it breaks back below. So if you took this trade, you would have gotten in here, right? And you would have gotten out when it broke below here, right? So that would have been a profitable trade, Depends on how long you wanted to hold it, through this. This is obviously a pretty big move, so you're not going to get a huge move like this every time. But we'll look at some other ones and we'll look at some where it would have hit your stop loss. So let's just assume that other factors said that this was a good trade. We had really good volume. Maybe this was a resistance level that it just broke already, whenever it broke through and crossed up. Actually, this wouldn't be here. It would be, let me change this here real quick. So you would take it on the break here, right? So you're looking to take it on the break up, right? So it broke up here, then you would dump it down here. Now, obviously, on the way up, you can do what I do, and you can start, you can scale out, right? You can scale out. If you have other EMAs on here, and let's say that you started below the 200 EMA, and you took the trade based on whatever EMA cross, as you start crossing those other EMAs, you can actually add to your position if you want to do that. If the trade still looks good, and you say, hey, we just busted through, and I took the trade based on, the 9 crossing the 200, and then now I'm going to add more when it crosses the next EMA, the next EMA, the next EMA. You can do that as well. But you can certainly scale out going up here as you're on the way up, or you can just do what some of these traders do. What they'll do is they'll just hop in. Keep in mind, you have other indications that said it was a good trade. You're not just taking the trade based on this 3 crossing the 9. So some people are just taking that trade there, and then they hold it. They don't care how high it goes up here. They just hold it until it crosses back under. And I'll show you a couple of examples if I can find them, where what will happen is the price will get way up here, right? And then it'll tank back down, but it doesn't cross back under. So, but yeah, you're getting nervous because you're like, man, I had profit way up here at 636, and now I'm down here at 610. So you're thinking, dang, man, I should have taken that profit at 636. Well, as long as you're not crossing back down below, you still have that chance where you can pop back up, right? So they'll hold it, and there's some examples where this thing just never broke back below that 9 EMA and screamed back on up and broke way above this 636 level before. So that part, totally up to you guys how long you hold it. But that's an example of a pretty popular scalping strategy. Some people, instead of scalping the way that I scalp, they're scalping off of the 3 and 9 EMA. And you can scalp off of the 9 and 20 EMA if you want to. Just make sure and back test whatever strategy that you're looking to use to make sure that it's going to be a good one. So let's change this back to 20. Okay, and then some people will take trades based off of the 9 EMA crossing the 20 EMA. So we saw that here. Let's look at another move here. See if we can find a better example. Okay, so you had a cross right here, right? So we crossed here, and maybe one of the rules for yourself is that you wait for confirmation. So maybe you don't take an aggressive trade here. Maybe you wait for confirmation to make sure that within 1, 2, or 3, or however many candles you want to wait, whatever your rule is, that you're still maintaining 9 EMA above the 20 EMA. Maybe one of your rules is hey, I don't take the trade on the break. I don't even take the trade waiting 1, 2, 3 or candles after. I want to make sure, I want to wait until I start seeing some separation, right, between those EMA. I want to see a gap, right? Because once you start seeing that gap, what does that let you know? Well, just what we talked about right at the beginning of the session. There's more strength. Once you have the bigger gap, there's more strength in that move. So maybe you're a little more conservative, so you're waiting for this gap, right? So maybe you hop in here, or here, because it's starting to gap now, and you've got better relative volume down here than you did previously. Okay, so maybe you take the trade here instead of taking an aggressive trade here. Obviously, you're going to make a little bit less money, but you're going to probably get stopped out less because a lot of times until you see that gap start happening, there's not as much strength there. But again, you can always take a look at your corresponding volume there, and that'll give you a real good idea if it's strong or not. And we can also confirm that this isn't very strong by looking at the corresponding volume, right? If we look at the corresponding volume here, yeah, it's not that strong. This move here was stronger than what we have going on here. So that's, again, totally up to you, however aggressive that you want to be when you're taking these trades based on the EMA crosses. So let's look at a few more examples of, let's just say we were trading this thing. So we took the trade here, right? So we took a trade here because we had some volume coming in. And keep in mind over here, the volume is going to look funny because this thing had so much volume. Look, don't forget to look here. This is in the millions, okay? So even though this looks like a small volume candle, it's 323,000 shares traded on that 1 minute candle. So pretty solid volume. So I took the trade there, and then we hopped out here, right, when it crossed below. Now, what some traders will do is they trade both ways. So they traded it up on the cross down there until it came to this level, and then they dumped it here, right? And then they waited for confirmation candle on this break below, when the 9 broke below, see, the 20, right? So now we're kind of in a bearish pattern. So here, maybe they wait for confirmation candle here, and then they short. So now they're riding it down, and they're making money on the short, right? And then so they shorted here, and then they don't get out until they see a break. Maybe they got nervous and got out here whenever the price started going up. But if they have the rule that, hey, I'm going to stay in the trade until the 9 EMA breaks back above the 20 EMA, right? So they're still in the trade here. We haven't broken the 20 EMA yet. We got close, and we're probably getting pretty nervous here because we're starting to see these two EMAs converge, which means that basically there could be, that trend is slowing down, right? And there could be a change in price direction. But if their rule is, I'm going to hold it until it breaks the 9 EM or the 20 EMA, then they're still in the trade, right? So they're still in it, and let's see how that trade would have worked out for them. They're even still in it here. It doesn't. I'd have to zoom in there, but I don't know if it broke that or not. But anyway, they either hopped out here or they hopped out here, right? One of those two places, short. They either hopped out there or there. But it was a favorable trade for them. They shorted here, and certainly was a great trade. Okay, so let's look at a few more examples. I'm going to take these off because I'll forget about them, and later I'll be like, what are those arrows for? So pardon me for just a moment. Okay, so let's look at some more examples. Let's look at this example here. So again, we are converged down here, right? Here we broke above the 20 EMA, okay? Now look at, we start gapping. So that's showing what? This looks like a halt down, a halt up right here. So this halted up here, right? And then gapped up off of the halt. But if you look at the separation, it's starting to get stronger, stronger, stronger. And when you look at your corresponding volume, it's solid, right? So volume came in here, 577,000 shares. Volume came in, it halted up, and after that halt, volume really soared in, right? And we're starting to get a big gap here, and everything looks good on that trade. So once again, if you wanted to be aggressive and you got in on the actual cross, you could. Or if you wanted to wait for confirmation candle, you would have gotten in likely before the halt, because this confirmation candle even had better volume. So you got in, it halted up, and you would have held this trade until, well, you could do whatever you want. Obviously, you could scale out all the way up here, wherever it's going up here. Or if you wanted to wait until you cross back below, then you would have gotten out right in this area here. Either way, it would have been a profitable trade for you. And we can look at some different tickers too. This is just, let's see here, pull back one other thing. This is just one example. Let's look at, I'm just going to pick something off my watch list. Let's look at NRXP. That thing ran, right? So let's look at this one and see how this did. Give me a moment. Okay, so let's trade this at the open. Let's see what it did from the open here. Okay, so not too much going on there. If you wanted to take a short position when you saw the breakdown here, you could certainly do that. Came back here. So here would be an example where you might have gotten stopped out. So this looks like it broke the 20 EMA here. But if you took that aggressive trade there without waiting for confirmation, then likely you would have gotten stopped out, right? But if you took this break, which would have been with your confirmation of corresponding volume, right? You got much better volume here than you had on this break. If you look at that break, there's really not a lot of volume there, right? So if you look at the second break, then you've got some corresponding volume coming in here, and especially on this next candle here, right? So this break, if you took the trade here, and then you didn't, let's say that you're one of those guys that you don't like to scale out, so you just wait until you're going to wait until it breaks back below the 20. So you would have exited the trade somewhere here, right? Still would have been a profitable trade for you. You would have given up some profits, not scaling out here, but would have been a profitable trade. Okay, so but that's how, if you look at, this is how you can take a look at, if you do break and you're like, okay, I should take this trade because it broke, right? Well, if you look at your corresponding volume, well, maybe you shouldn't take that trade, all right? And it also didn't break very, very heavily either. It was just kind of starting to break. So if you waited for your confirmation candle next door, well, you likely would not have taken that trade based off of other indications. This is why we don't take every single break of that using that particular strategy. And there's a lot of traders that do. One second, guys, here.